I can zip back and forth. Okay, so to keep on track of time, I think we should begin. Welcome to the Venture Capital and Private Equity session. It's very great to be here at EFMA every year. One of my favorite conferences that I've been coming to for over 20 years now. I'm feeling like an older guy, but it's really a terrific event in a terrific city, and we're very fortunate to have three great speakers in this panel and one not so great moderator, but I'll do my best to keep everybody on time and offer some good comments, I hope. So our panelist to my left is Gordon Phillips. He's the Laurence Whittemore Professor of Business Administration and Faculty Advisor for the Center of Private Equity and Venture Capital at Dartmouth College. On the my far right, your far left, is Albert Sheen. He's previously at the University of Oregon and now at the Securities and Exchange Commission. He has a very interesting paper on misconduct, so perfect guy for that topic. And then immediately to my right, your left, is Professor Massimo Colombo. And if you're in European venture capital, you know that he is the most important guy in the topic. He literally controls everything in European venture capital, has all the great data, and is the godfather to all the PhD students in Europe. So really great panel. I will just quickly introduce the paper, show a few connections between the two. So Gordon is going to talk about a legal decision, Alice versus CLS Bank International. It's a Supreme Court decision in the US, 2014. Affected patent protection, so reduced patent protection. He's got really interesting paper with machine learning, and we just lost our screen, so hopefully that wasn't me. With machine learning, and essentially shows some differences in how that influenced the venture capital market, increasing competition, increased the supply of venture capital into this product space, among many other interesting results. Albert has a paper that really caught my attention this year. One of my favorite topics these days is on misconduct. And normally in the private equity business, we see papers that say private equity managers bring governance and they reduce misconduct. And Albert's going to tell us the exact opposite. So instead of, dog bites man story, he's got a story about man bites dog. So it's really quite a fun paper. And the rise in misconduct amongst these firms is large and pronounced. So we have an exciting paper from Albert. And then Massimo will talk about signals in the VC market. Signals can potentially become a double-edged sword, and he's going to show some tensions between the reputation of the venture capitalists versus the reputation of the stock market. So three great papers. After they do their presentations, I am going to be the bad guy. So as I say, we're in Rome, I get to paraphrase Mark Anthony, so I will not overly praise, I'll bury them after their presentations, and we'll have plenty of time for questions from the audience. So turn it over to Gordon to go first. Thank you. Can we switch the slides, please, to Gordon's slides? Thank you. Oh, no, it should be, so from the Control Center, awesome.
I'll just say thank you first for the great invitation. It's very wonderful to be here in Rome, although, as we're saying, we even get to exercise in the heat, so maybe that's good. I haven't had enough exercise recently. But it's wonderful to be here, and thank you for the invitation for the conference organizers. This is a paper which is kind of a mix of law and economics, if one has to categorize it. And we're looking at innovation, and that is in particular intellectual property protection. And so we came up with, to take a little riff off of John Milton, Paradise Lost, intellectual property protection lost in competition. And it's an age-old topic, right? What happens with patent when we protect intellectual property? We need to, but if we protect too much, we give a monopoly to the person who gets the intellectual property protection. So this joint work with the first author is a computer scientist. The next author, we've got a fellow at University of Amsterdam. We've got two people, one from Turkey, one from Amsterdam, so it's an international collaboration. And then Jerry Holberg from USC, and I'm at the Tuck School of Business at Dartmouth College. Okay, let me jump in. I think we all know, I won't spend a lot of time on this, we only have 25 minutes, but intellectual property is key to a country's growth, right? So we want to encourage intellectual property protection, but at the same time, the original classic theory from Nordhaus, it's a trade-off between we encourage, by giving a patent, we encourage you to go do the innovation, correct? But then subsequently we face decreased competition and potentially increased prices. So if we make patent protection super strong, it may actually decrease entry, right? And there's a bunch of economists who have been entering into this debate, and they even write a Journal of Economic Perspectives paper titled The Case Against Patents. So you can see right there what the whole paper is about. They're basically saying patent law is bad because it discourages, by giving a monopolist, it keeps people out. Maybe the initial person is encouraged, but then it keeps people out of entry. So they claim and they review a lot of studies which conclude patents stifle productivity growth and they stifle innovation. But however, there are some issues, and we're going to look at this a little more closely because we don't have the ideal experiment. They are looking at the things they look at in the past were kind of one-off. For example, if I get a patent, then maybe not surprisingly, Douglas is in my area, he won't enter. But what if there are no patents? Then the question is that necessarily good for all concerned? Because we may go too far if we overrule them. And there's been a lot of debate about big technology companies and how these companies may have high market share and they may be monopolizing the markets. And so how does IP protection impact competition? We're going to be looking at between the high market share firm and their smaller competitors. So we're going to see a lot of mechanisms that firms have to protect intellectual property. If you take away the patent, they will move towards secrecy and trade secrets. So a large literature here. I think, let me just highlight a few things at the bottom there. There's a big debate. In most of these papers you can find on either side where recently some people are saying we do need patents to encourage innovation. We do need them to encourage. We can see the case, of course, internationally. And we don't deal in this paper with China, but we had another paper, we look at Chinese innovation, and to the extent they basically encroach on other firms by just taking their innovation and using it, right? It may hurt, of course, the firm that's encroached upon. So I will just mention the last paper in here, Ferramensa and Hege and Lundquist. First patent grants are very valuable to small firm financing growth and increased probability of additional patents. They put a value on it being $40 million in the venture capital space if you have a patent. So if you don't have a patent, it's much harder to get the financing as a small firm. And that's going to be, we're going to see there's definitely some benefits of patent protection and there's a cost and benefits. So our paper, we're going to look at this Alice Corp decision versus CLS Bank. It's not broadly anticipated. There was negative stock market returns when it was announced. The Supreme Court came along. It invalidated large areas of patent protection in business methods, media, and systems. And say it's only 4 patents, but there were huge players lined up on either side. And at the very end, I'll tell you, maybe you can guess, there are amicus briefs that are filed. And we look at the identity of who filed the amicus briefs. It gives you an idea of who might be on either side of this debate. And in fact, like you get a company like Facebook, Microsoft, and so forth, they filed against the patent in favor of CLS Bank, because Alice was suing CLS Bank. And then on the other side, though, we did have IBM supporting Alice, that these patents should be protected, and a number of other actors also on the other side. There was about on either side, about 40 amicus brief, which our friend of the court filed in this case. Very influential. Subsequently, even though it was 4 patents, the USPTO, Patent and Trademark Office, will look at patent applications, and they rejected 33,000 patents, citing Alice as the reason for rejection. So it had a huge impact. It affected, you can see all these different categories here, but nearly everything which uses a computer, business methods, even analytics, and you could think signal encryption, all these things, including finance patents as well. Okay, so what we're going to do is we're going to train an NLP, natural language processing. It's a neural network, very latest thing called BERT. If you want the actual name, it's called bidirectional encoding representation from transformers. So it's a machine learning model. It's the latest thing. It takes a lot of computer time, but luckily we have that. And we train this model. We look at the pre-existing patents, because even if you have a patent prior to Alice, the value will diminish. Because if somebody will encroach upon you because they know you will not be able to defend yourself, and then subsequently your patent will be invalidated. So it's like but until you sue, you could say, I have a patent, but it is essentially worthless at this point. So, but we don't know that publicly that it's worthless. So we have to use the machine learning model to classify whether or not this previous patent, if brought to court, will be invalidated. And we have a lot of anecdotal evidence that is the case. And we actually have a holdout sample. So we use kind of the latest NLP methods, natural language processing methods, to assess the effective decrease in IP protection on a firm's patent portfolio. So we look through 642,000 patents. We look through the patent text, and we calculate the effective decrease in the intellectual property protection of a firm's patent portfolio. So we have the patent portfolio for every firm. And some firms have like 100,000 patents, like Microsoft. And you'll see there's a big effect on Microsoft, a big negative effect. However, they didn't suffer too much. We'll see they used other methods subsequently to offset the loss in patent protection. Okay, so we'll look at ex post competition. And by large and small firms that we identify as being exposed or treated by Alice, and this is called a hidden exposure model, because we don't know for sure. So that's what we use, the machine learning model that we've trained with actual patents that have been accepted or rejected. So we have a nice training set, and then we can go to all the 642,000 patents and then assess the probability that they have a decrease in intellectual property value. So we find in general, here's the big findings. High market share firms gain. So if you had a high market share prior to Alice, this helped you. Because what happened, and you'll see that this, you have increased market value, sales growth, they decrease acquisition activity. So what happens, instead of buying you, if your patent is now invalid and you're a small firm, the big firm will actually just, quote unquote, borrow your technology. And there's nothing you can do, even if you have a patent, and there are some people who've sued, like Facebook, and they lost, and the reason they lost is because of Alice. This is no longer a valid patent. So essentially, the big firm like Facebook, and you see this in the latest things like Instagram and so forth, they've copied like TikTok, and they can copy legally. So if you like no intellectual property protection, that's good for you, especially the big firms who maybe have the data scientists who can then just copy other people's innovation. And then there's less litigation. That might be a good thing, you could say, especially by non-producing entities or patent trolls. If you know what, these are entities which are set up, they help small firms actually defend their patents, because if I have a patent, instead of suing, I will basically license it to someone else, and they will sue the big firms for me. But now that these patent trolls, so to speak, will no longer engage in this activity, because the probability of winning is gone down. So the legal lawsuits have gone in. I think that's also good. But that means, again, the large firms benefit because they don't have to defend themselves as much. And they face decreased direct competition. But small impacted firms, they decrease patenting. They face increased competition across multiple measures. They increase R&D, so they try to get out of this, the fact is I now have to innovate more. So that may be good, right? Consistent with Aggion and all. However, even though it's good, there's more competition, there's decreased operating income and market valuation of small firms. So the small firm space becomes much more competitive. And if you want the competition, that's great, but now realize that the big firms they have other resources, and that's what we show. There's other resources they can defend themselves, and they can maybe even, quote unquote, borrow the technology from the smaller firms. Okay, so what do the small firms do? They're in trouble. They use alternative methods to increase secrecy and replace lost IP protection, including non-compete clauses and non-disclosure clauses. So they engage in other legal ways to protect their intellectual property. Okay, so what do our findings suggest? And I'm not going to go through all the details, given that we have 25 minutes here, but I will try to get the highlights and give you a good taste of it, and then please email me for the paper. You can find it on my website. So we do think IP protection actually has some value, so we don't want to get rid of it totally. If we had to make a policy implication here, we would say that IP protection serves an important role to moderate the power of high market share firms if you give the patent protection to small firms, right? And a lot of the small firms were getting that patent protection, and that hurts the small firms, the loss of the intellectual property protection, the loss of the ability to patent, because they're less able to protect their market segment. And then again, then the large firm benefits because less firms out there are willing to enter because there's no patent, and then the large firm faces less direct threats by the small, low-share firms. So in the end, I'm going to be like an economist, unfortunately, where FDR said, he says, whenever I have an economist, they say, on one hand, this, on the other hand, what about this? It gives two sides to the picture. So Franklin Delano Roosevelt said, well, what I really need is a one-handed economist. So in this case, we have a two-handed economist. So there are costs of decreased IP protection. That is, the fact is small firms who rely on that really get hurt. You could say there's some benefits of if I get rid of IP protection. It increases small firm competition, and we have decreased lawsuits or decreased patent troll activity. So if you want lots of little small firms competing, that's good. But on the other hand, the existing small firms will have a hard time, competing against the big large firms. So this is the Ellis decision. It was 4 patents. And again, they covered method, system, and medium for mitigating settlement risk. And it was a finance patent. So there was a method to carry out obligations for, again, hedging essentially, and risk management. And as they had 3 different elements of their claim, and they were all ruled invalid. So the patents were overturned. And it went back and forth initially. This was a surprise. We have a nice exogenous shock here. So early on, the district court said, oh, the patents are invalid. But then the circuit court said, oh, they're valid, 2-1. These are valid patents. And it was 5-5 on one claim. So that means the previous court judgment stood. So it looked like the patents were valid. But then, however, the judges couldn't agree even at that point. So they had the Supreme Court, and then Jesse would tell me the exact term, there's some kind, they decided to hear the case. And they affirmed the decision of the circuit court. They were not patent eligible. It was 9-0 even. So they said, no, these patents are not valid. They were not unique. They were not patent eligible. It was too obvious. It failed, again, this kind of there's certain tests for patent law. And then the impacted firms had a big negative reaction. So it was surprised. Average was only minus 0.1%, but if you look at the top 5%, the excess returns, even for some of these large firms, were very negative. They were fairly to the left of minus 0.8%. And again, you'll see subsequently, even though those were 4 patents, 33,000 rejected. And there were 12 mapped industries. So it wasn't just one industry. There was commerce, there was finance, there was payment systems, video games, computer securities, measuring and testing. So these were huge areas in the US that were ruled not patent eligible, at least for basic claims. But it wasn't 100% because you can see none of these categories were 100% ineligible. Computer security was 5.2%. Even finance was 42%, but 58% were still valid. So that tells you that there's no way of knowing in those categories if your patent was valid or invalid per se, except if you knew it yourself. That's the point. Market participants could figure it out, but we have to use machine learning on this larger set of patents. So here's an example, and then there was a BlackBerry versus a Facebook. This is one where BlackBerry was suing Facebook, and they were essentially, they sued for patent infringement and lost, and the patents were ruled ineligible. You can see some of these patents were ineligible, very detailed patents. But here's again some of the categories that were affected, even things like microbiology. You could say, well, why is that? It's measuring or testing. Even like, we went through the COVID tests. The COVID testing systems are not patent eligible. So someone can develop their own test for COVID. You say, what's the incentive to do it? Well, again, if it's easy, fine. Even if you don't get a patent, you'll compete on other ways, distribution, marketing, so forth. Okay, so we use this BERT to go through, and this is a method which to classify existing patents. We look at on all the patent texts. So we have 642,000 patent texts we have to analyze, and we do a holdout sample as well. In the end, before we use it, we train the model, and we basically take 23,000 patents. Of the 33,000 rejected, we take 23,000, we hold out 10,000, and that's a holdout sample. We find other patents that were accepted, so we can assess the goodness of fit of the BERT model using a holdout sample. So we do this, and we compute these measures, which are very common in machine learning, precision, recall, F1 score, or accuracy. You have to weight these, and you can assess the goodness of fit of a machine learning model. And so here's a bunch of different statistics which compare very common natural language processing models. And you can see the top line is the one we use. Of course, that's the most accurate. And we assess, it does have a good fit. So you can see at the very top, anywhere from 78% in accuracy to 73%. And if you look down the rows, you get TF-IDF, if you know what these are, and you combine them with prediction module like linguistic regression, decision tree, or random forest, and then we have word-to-vec2, and this BERT model is the latest transformer model. It's a neural network model, and it really does outperform. If you read about it, they released it just recently in 2019, and it's the one where it will predict what you're going to say before you say it, right? It's the model that they're using now to even write whole responses and letters to people, if you give them the topic and so forth. So it looks at existing letters and then tries to replicate it. And it's very good. Even people in the areas where it's used have a hard time determining whether this was machine written or whether this was, again, human written. So we use this model to detect whether the patent would be vulnerable and would be rejected if it was evaluated, right? And then we go through and find it does very well. And then we go back and look at the existing patents once we've got our model, and we classify the loss in their patent in their value. So here's sample patents flagged by our model. You can see Qualcomm. There's some large companies, Qualcomm, Oracle, Microsoft, Goldman Sachs. If you look at Qualcomm in yellow there, one of those patents was worth $1 billion, because these are in millions. Supposedly by one valuation technique. It was an algorithm to process sounds and voices. That had a very high treatment score, which means it would be likely rejected if it was brought up, if they sued for encroachment, which means other companies can encroach on Qualcomm, right? And we have Microsoft there. Microsoft is pretty high treatment, about 22% of their patent values were affected by this case. One very prominent one you can see here's a method for visual display for flagging images, for flipping images in a window using overlays. And you look at this, it sounds a very simple title, but then there's several pages of patent text we use to analyze the probability of being rejected. And then there's small companies that are affected. You can see all the way from Blucora to Affirmex to Rambus. And these are things which deal with DRAM. On the last one, Rambus is almost all just patents. They had a huge, 60% of their patent value was impacted, according to our metric, by this Alice decision, which means they lost 60% of their patent value just by this decision. And we look at the excess returns, it holds up. We do find indeed there's a correspondence. It's a computer memory method tracks which can be used for data settings and dynamic random devices. Okay, so keep going. Then we go look at all these firms. We have a panel of public firms, and then we use a bunch of different methods here. Basically, a lot of them are natural language processing methods, but we're applying them to areas we're all interested in, like patents and innovation. So we have 1,490 patenting firms, and we look at firms pre and post Alice. So I'm not going to go through. We use Google Patent Text, all the other data here. We use lawsuit data from the Stanford Non-Performing Entity Litigation Database, and so forth. So here's a measure of how important it is to firms. We don't have all the time, but I'll calculate. Essentially, we do it several different ways to show you the measure of the patent importance and then the overall portfolio effect that and we have firm balance across treatment. If you look at size, of course, the treatment is high treatment, low treatment, so that's going to be different. But then again, size, assets, and sales are very similar. We look at ex post outcomes. That's the major thing about the paper. We have all this upfront apparatus, which is very relatively complicated machine learning stuff, but we want to show you the economics here. We look at the patents, the R&D, we look at the competition, and even in the competition, we look at VC-financed entry. And then we have firm and year fixed effects. So econometrically, we can look at, like pre and post what happens to a company like Rambus. So not surprisingly throughout, no matter what, the patents go down for big and for high market share and low market share firms. Turns out The high market share firms actually patent even less because they don't need to patent anymore. They use more trade secrets, everyone does. But the R&D goes up primarily for the small firms because they're the ones drastically affected, and they cut back on their R&D. That's columns 5 and 6. You can see we do this different ways. Here's a graphical time trend, which shows you what happens to the market share pre and post. Right in the middle is 2014. That's the drop. You can see the standard errors, for those who are interested in the statistical significance. R&D for small firms initially goes way up to about 40% increase. But then it drops after 2 years because again, it's harder to do R&D because you're not getting the ability to patent it, or else they just basically keep it quiet about it. We're not 100% sure in terms of reported R&D. But what happens here, we look at performance and valuation. Again, what happens, small firms, the low market share firms have a big negative impact on Tobin's Q and operating income. The large, already high market share firms actually go up in value. And then here's the competition, and this is the $1 million one we find. This is the key slide. Look at the venture capital financed entry. It goes up for all these areas, but especially into small firms because they don't want to challenge the large firms. And they have more similarity, more complaints. Small firms complain. These are text-based measures. Venture capital financed is VCF. You can see an increase in entry, 11 to, those are, again, 10 to 11%, only 4% increase into high market share areas. So that is the venture capital side of things. So we have a graphical time trend here for the small firms. You can see, again, the percentage increase that we're getting 10 to 15, 20% increase. Okay, there's even firm product encroachment. I know I'm coming to the end, and I promise, Douglas, I got to make sure I finish in the right amount of time. You can see the IP risk goes up, non-compete clauses go up, non-disclosure clauses go up. So small firms are using alternative mechanisms to protect their intellectual property. And then you can see the lawsuits. The key one that's impacted is the small firms were never sued before, turns out. No one sues the small firms because you sue the firms that have lots of cash. That's the key thing for lawsuits. You're not going to sue firms that don't have much cash. You might drive them out of business, but you're not going to get anything from it, right? So you sue the small firms, the large firms, and there's a huge decrease in the number of lawsuits for large firms. So they like this. They like this because no one is going to sue them because they're not going to get a payoff. So that's exactly what happens here. Large firms buy fewer firms. That's the acquisition results. So they're not going to buy as many small firms anymore. And we don't have the direct smoking gun, but our implication of this is instead of buying the small firm, they can basically have their data scientists reverse engineer what you're doing. So they don't need to purchase the small firms. And that decrease is pretty large, 16% to 14%, depending on the measure. Very significant with all the proper firm fixed effects and econometric size of things. So here's the conclusions. I think you know already. We examine a lot of patent text, 642,000 patents. Basically, low market share, small firms lose, high market share firms gain. So if you take away patent protection, the firms that lose the most are the small firms because they get a lot of financed entry, which might be a good thing for consumers. We can't say on net what happens to consumers, but the big firms do gain. And so here's the kind of interesting bottom line we found after writing this Alice amicus briefs at the Supreme Court. You can see who favored getting rid of patents and who favored keeping them. So keeping them are the pharmaceuticals, the international business machines. They have a lot of patents. They get patent royalties. And then a lot of others favor keeping the patents. That's in support of Alice Corp. And then we even have professors on one side, Daniel Spielberg, Richard Epstein, and then on the other side, CLS Bank, which is, again, who wants to get rid of the patent protection in these areas. You've got Google, Amazon, Netflix, all these big tech companies. They don't like patents because you say, why don't they like them? Because the small firms will then sue them, because the small firms will then license their patent to patent troll, who will then sue Facebook or sue Google. And the professors on that side were Bronwyn Hall, Eric Maskin, and FM Scher. So you can see, and CLS Bank, well, Alice lost, and then that's the result of what we see is all this shakeout and increased competition in the market. Thank you.
Sure. Thank you. Albert's slides, please. Clicker.
Great. How's my mic? It's good? Great. And thanks very much for having me. I was just telling them I haven't been to Italy in like 20 years, and it was hard getting here. I left Tuesday morning from Washington, D.C., and I made it here about 10 minutes before the session started, so the timing worked out just great. So you can see here, I'm now at the Securities and Exchange Commission. This is very recent. I didn't know I'd be working here when I started this paper, so now there's this interaction. I have to do these things and put up these disclaimers, and I had to send this to legal to make sure it was okay for me to say these things now, since I'm supposedly an insider on some of this information. Okay, so what is this about? There are a lot of investment advisors. So these are the people you go to, I don't know what to do with my money, help me invest it. And I was surprised, there's like 500,000 of these in the US, 500,000 people who work as investment advisors, managing a lot of money. And there's another paper, okay, that's sort of recent that started looking at this, looking at misconduct data. So every investment advisor through the SEC and FINRA has to report. You can look at their profile essentially, and you can see when they've made mistakes, you can see when they've committed crimes, and they put out a paper that suggested that about 7% of financial advisors engage in these kinds of crimes. And combine that with the fact that private equity has become really, really interested in financial advisors. There's a bunch of articles we pulled out. They are, this is the hot trend in private equity. They love buying up financial advisors. And so the question is why, and what do they do, and should we care? That's really the purpose of this paper here. What is the effect of private equity, and how does private equity affect misconduct? How should we as consumers care if private equity firms take over these businesses? Okay, there could be two sides to it. It could be a good thing that private equity has taken it over. They have, there's been a lot of papers, as Douglas mentioned, that shows that they might have good skill, they might manage things a little bit better. It's probably bad for business if you get caught doing things, so you'd lose money. You'd think maybe private equity would want to stop that. On the other hand, there's potentially negative aspects. There's profit maximization that might lead them to do things that are a bit perhaps not the best for consumers. And so we're just going to try to find out, private equity, what are they known for? Strong incentives, really want to make money. That's what they care about. And so what's the best way to make money in the financial advisor industry? That's what we're going to try to figure out. And as Douglas also mentioned, there's a lot of work looking at private equity in various industries. I've got a couple papers that suggest generally positive outcomes, cleaner restaurants or better productivity. There is also some more recent work that's a bit more on the downside for private equity, looking at, in particular, industries where it's hard to really tell whether you're getting a good product or not, like online education or healthcare, where it's a bit more opaque. As you mentioned, this paper goes on the negative side, which I think is good for me, because all my previous papers have been pretty positive on private equity, so I think it shows that I'm not just a shill for private equity. If I can have some positive and negative, I'll go wherever the data says. So the data for this project, like I mentioned, there is a database where every single person in the US who works as an investment advisor, you can look up their profile, what their education is. You can look at what year they cheated this client, and with sometimes pretty gory detail on what exactly they did. Qualifications, and we got 20 years of this kind of data. There's sort of a separate database that covers investment advisory firms. So like LPL Financial or Mercer or things like that. And this database covers ones that have over 100 million in assets. And this, we pull out some extra cross-sectional type information that we'll use, like what their clients are like, who do they serve, where are they located, and things like that. And lastly, we pull out a bunch of PE deals from PitchBook. This is what I mentioned before, P is getting really interested in this space, and you can see that right here. Really taken off in the last few years. They've been buying up a lot of financial advisory firms. And so we're including not just when private equity buys up an individual firm, but we're including add-on deals where they buy up, one large firm, and that firm then goes and swallows up lots of small firms as well. So there's different ways in which they get involved, but we're counting all of that. Okay, there's always so many tables and numbers. You never know what to look at right here. So just some summary statistics. Right here, this number, 0.711, that's in percentages. That means that 0.71% of advisors in our set have at least one misconduct in a given year. So a little bit less than 1% of people in a given year do something wrong. I haven't mentioned too much yet about what this misconduct is. And it's broken down into some categories like civil, criminal, regulatory, customer. To be honest, in our reading, there's a lot of overlap between these things. If you just look at the detail, you'll see things like, so-and-so, Mrs. Jones complains that this advisor put me in inappropriate investments or signed my name and took money for himself or things like that. There's all sorts of misconduct that you see here. I'm going to do one thing later with this breakdown that I think is useful, but for now, it's all just sort of a mishmash of different types of problems that you might encounter. So anyway, the main thing here is the frequency, less than 1% per year, so that's still quite a lot of people. And then at the firm level, what do these firms look like? About $4 billion on average is what a financial advisory firm manages, and they have about 46 financial advisors, though some are really big. Obviously some huge firms that cover lots of people, and there's one-man shops as well who do this sort of thing. As far as the different types of violations, customer, one way to distinguish between these is who initiates it. Did the customer come forward and say, you did something wrong to me? That would be customer. Did the SEC initiate it? That would be regulatory, things like that. Okay. So we're going to do this is a bunch of econometric stuff here, but there's two things we're fundamentally going to do. First, we're going to begin by saying, who does private equity like to buy? Do they care about misconduct when they're looking at who they want to partner with? That's a very simple expression up here. Then the second thing we do is, let's suppose private equity has bought somebody. What is the effect? That's sort of the main point of this paper. And the first one was just a very simple regression. This one, just econometrically, we do something called a stacked cohort indifference, where, lots of text here, but essentially what it means is for every single firm that gets bought by private equity, we find up to 4 other partners that look a lot like them, based on things like how big you are, how much misconduct you have, how many people you have, things like that. And then we run a specification where we essentially look at before and after what happens to the private equity bought firm, and we use as our counterfactual the other 4 people that didn't get treated. Okay, so that's the econometric specification. All right, what did we see? First of all, private equity prefers to buy firms that are clean. They don't like firms that have already a lot of misconduct to them. Once they get bought, though, the misconduct record worsens for these previously well-behaved firms. And I'm going to talk about some mechanisms, I didn't list them out, to sort of show exactly how they enable this sort of thing. Okay, so this is the first thing. What do we look at here? Just very simply, those 2 numbers at the top are negative. That's the probability that you get bought. And you can translate into magnitudes down there at the bottom, but essentially this is just confirming that private equity prefers to buy firms with significantly less prior levels of misconduct, clean firms. This is just breaking it down by the different types. I'm going to skip this for now. Now what we're going to do is we're going to compare firms with treated firms with untreated firms. And the only takeaway from this slide is, and Gordon had one very similar, they kind of look similar. There's not a big difference in any of these size, amount of misconduct, anything like that. So this is just to show you that when we look at all these results, we're finding counterfactuals that at least observably are kind of similar. All right, so this is the first main result here. Right there, this says, now this is at the advisor level. So what we're doing is we're taking all the individual people. You see the number of observations here is huge because we're looking at individual people. We're looking at a firm and we're looking at the mass of advisors before and after they get bought by PE. And what we're seeing here is that there is a 0.23% higher chance of misconduct. The unconditional mean was 0.71%. So you add these up, instead of like 0.71%, now be like 1%. So that's a 32% increase in the amount of misconduct that is happening among the people at these targeted firms. Pictures, give it about 2 years or so for things to kick in. Now, this is that exact same thing, but it's broken down by category. It splits the misconduct into civil, criminal, regulatory, customer, and termination. Okay, the only takeaway I have from this is in our reading of the violations, some of these seem more related to your job, and some include extraneous things. So, regulatory, if the SEC is coming at you for something you did incorrectly, that's probably very much related to your job as a financial advisor. Criminal, on the other hand, includes any kind of criminal activity that a person might do. A felony, maybe you murdered somebody. These are activities that you need to have recorded, but are not necessarily related to your job advising people on their finances. And so what I think is interesting from this table is the effect is all coming from regulatory and customer, your actual financial advisee customer complaints. Not so much from the types of violations and misconduct that may be totally unrelated to your job. If you murdered somebody, so this makes me feel a little bit better that we're capturing something that private equity might actually be doing, because they're not probably getting into your personal life and figuring out your personal bankruptcies and felonies. They're probably, if they're doing anything, changing the way you work. And those types of misconducts are the ones that are driving everything. So that's what I think I take away from this. Now, in the previous analysis, we didn't have any advisor fix effects. And so what we were looking at is just the mass of advisors before and after. That, to the extent there's a change, there could be two reasons for that. It could be that existing advisors are becoming worse. They're getting corrupted, the same person. Or it could be that the good people are getting kicked out and we're replacing them with bad people. So those are two different ways of getting that same result. So this here, the earlier result has no advisor fixed effects. This result, we do add advisor fixed effects. And the takeaway here is the numbers, even with the fixed effects, the numbers are significant. So, it only drops by a little bit for the frequency, the amount dropped by 50%. So what this says is it's actually the same people that are changing. They are getting corrupted, not getting kicked out and replaced by bad apples. But both are happening. Okay, now we're going to look at the firm level. And here again, so the number of observations is much fewer because we're looking at an individual firm. And let me interpret the coefficient here. 0.27% increase in misconduct, that actually translates to a much higher number of 147% and a 200% increase in incidents. Now, the reason these numbers look so big is the amount of misconduct increase that's happening. Remember, this is on the firms that private equity firms are picking, which are the really clean ones. So you take that average misconduct and you apply it to a firm that wasn't doing much misconduct in the first place, it balloons and you get these huge numbers. So you're taking the really well-behaved ones, adding a bunch of misconduct, and it's doubling and tripling the amount of misconduct that's coming out of these firms. Again, takes a few years. So I have like 2 or 3 minutes. I'm just going to show you 3 or 4 slides on some of the reasoning here. First of all, forget misconduct. After private equity takes over, do these firms increase their assets under management? A little bit, but it's not that strong. If, however, we break our sample into the firms that really blow up and the ones that don't, the ones with low subsequent growth, the numbers are much smaller than the ones with high subsequent growth. So what this suggests is the ones that are really growing, misconduct increase is associated with that. Here's something else. For firms, we have a variable where they sort of identify who their customers are. Institutions or retail. Take a guess at where the misconduct happens. Firms with retail clients that they identify, that's where the misconduct increases. Firms with institutional clients, there's nothing going on. In fact, they get cleaner. So there's a really stark break depending on who you serve as your customer. Suggests, who you can fool and who you can't fool in doing this stuff. Firms that management buyout deals where the management stays involved, no impact. So maybe the existing manager, their culture remains. Nothing changes, perhaps. And I think my last one here is, are you a private equity firm that focuses on financial advisors or one that doesn't? It's the firms that don't focus on private equity, don't focus on financial advisors that have the greatest increase. I guess the ones that do a lot of financial advisory work, we don't see much of an effect there. So maybe it's just the novices, maybe it's some, people who would think, hey, let's jump in and change things. But I guess this is somewhat good news. The more experienced private equity firms are at this, the less they do with misconduct. Okay, those are the channels we think things go through. Private equity firms buy clean firms, they make them worse. And that is especially apparent when you got retail clients and when you want to grow. So pretty simple story. That's it.
Perfect. Very cool. Thank you. Great presentation. To Massimo slides, please.
So waiting for the slide, I would like to thank you for this very kind invitation. Who give me I'm frequently in Rome, but I've never been in the campus biomedical, so it gives me the opportunity to visit it for the first time. And my paper is a joint work with a PhD of mine, Benedetta Montanaro, and is about signaling, right? And signaling and valuation of startups when they are acquired. And the important keyword in this title is sequence, right? So all of us know that signals are important for startups, and they reduce information asymmetry, and is a good way to find investors and to increase their valuation at any stage in their life, right? And more recently, there has been a bit more skepticism about signals, and in particular, the idea is gaining ground that not signals are equally valuable, right? And first signal may be stronger or weaker. And second, firms send simultaneously multiple signals, and this may stretch the cognitive abilities of signal receiver, right? And indeed, there is some work showing that weak signal may be reinforced by overlapping a redundant signal or by additional information which attract the attention of signal receiver. And we also initially, there is another idea getting ground that sometimes signals are accompanied by additional information which may have which may create drawbacks. So there may be a dark side of signals. Well, one aspect which have gone unremarked, almost unremarked in the literature, is that signal of different strength may come in sequence, right? And one reason why they come in sequence is that they may deteriorate over time, right? So companies sending a signal after a certain time may have incentive to send an additional signal to reinforce the original signal. But a question which, as far as we know, has been so far unanswered is, well, what happens when signal in the sequence have different strength? For instance, what happens when a company sends a weak signal after sending an initial strong signal, right? Or what happens when a weak signal is followed by a stronger one, right? And in addressing this question, these two questions, we make an important step in the paper is to abandon the original idea that signal receiver are perfectly rational. So we leverage the idea that there are cognitive limitations in signal receiver, and which is a common idea in the information processing literature, which is interested with cognitive bias. And so our idea is that signal receiver interprets signal sequences using heuristics. So the first idea is a very simple one, is that what matters is the last signal, right? So according to this idea, if a company sends a strong signal and then after the strong signal it sends a weaker one, well, signal receiver focus attention on the weaker one. And a second idea is even a bit more extreme, is that signal receiver get expectation based on the trend of the signal. So in this case, sending a weaker signal after a strong one is even worse because it creates a negative trend which generate negative expectation on signal receiver. And of course, the opposite applied when a strong signal is followed by a weak signal. So the key idea behind the paper is to take seriously the recency bias, according to which what matters is the last signal, or the offhand bias, according to which signal receiver form expectation based on the trend created by a sequence of signals. And we applied this idea to the evaluation of entrepreneurial ventures when they are acquired. And there is a literature which make us comfortable with the extent of information asymmetry when startups are acquired by existing firms. The two signals we focus attention well, it's very important to select signal which by definition come in sequence, right? And that's why we consider as the first signal receipt of venture capital, and as a second signal the fact that company go through an IPO, right? In general, company first get, in general, I mean, always company first get venture capital. Well, they may remain private and going through an IPO, but it's it's more impossible to get venture capital after being public, right? So the first signal is getting venture capital or not. The second signal is going through an IPO or not. And so there is a precise order. And second important thing is that both signals may be stronger or weaker, right? If you got venture capital from Sequoia or Accel, this is a very strong signal. If you got venture capital from a quite unknown local player, this is weak signal. And we focus our empirics on European and Israel startups. And this generate an advantage that we can distinguish the stock exchange where you are where you are listed. And for this type of company, going through an IPO at the NYSE or NASDAQ is a very strong signal. And while going through an IPO in any other stock exchange is a weaker one, right? So we have a precise sequence of signal, and the signal can come in two varieties, strong and weak. And so basically this is a description of what is going on in our paper. We focus attention on valuation and acquisition, and a company may be acquired when they did not get any venture capital and did not go through any IPO, so it's still a private company. Or the company, a non-VC backed company, can go through an IPO in a US stock exchange, so it's strong signal, or in a non-US stock exchange, a weaker signal. Or the company can first get venture capital from a low reputation investor, this is a weak signal, or from a high reputation investor, this is a strong signal, and then either remain private or go through an IPO in a stock exchange, depending on the quality of the stock exchange. Okay, what is our hypothesis? Our hypotheses are based on what the valuation of whether the valuation of company depends on the sequence of signal. And let's first, well, this is what I mentioned before, and let's focus on the first hypothesis. And let's imagine that a company which is backed by a very reputable venture capital investor go to an IPO, so the initial signal is very strong, they go to an IPO in a less prominent stock exchange. Well, our assumption that this is very badly received by signal receivers, and so our hypothesis is that going through an IPO in a less prominent stock exchange decrease the valuation of companies which are backed by very reputable investor, and this effect is much stronger in comparison to a situation where the company is backed by a less reputable investor, right? These are hypotheses 1 and 2. And let's turn to the other situation when the company is initially backed by an investor with a lower reputation, but it managed to go through an IPO in a very prominent stock exchange. In that case, there is a big positive, we expect a big positive shock on valuation, which is much higher in comparison to a situation where the company go through an IPO in a prominent stock exchange while being backed by a very prominent venture capital investor. And the last hypothesis in the paper compared two different situations where a company is first backed by a less reputable venture capital investor and then go through an IPO in a prominent stock exchange. And our assumption is that this sequence of a strong signal following a weak one has a much positive effect on company valuation than a sequence composed of an initially strong signal being backed by a very reputable venture capital investor, followed by a weaker one, going through an IPO in a less prominent stock exchange. These are the hypotheses which are tested in the paper, and let's go to the back end of the paper. The data we use come from a Resist Vico data set, which containing information, is a metadata set containing information, longitudinal information on the population of company in Europe, Europe meaning European Union countries, UK and Israel, who got venture capital investor from 98 up to 2014. With this, we have a matched sample of similar companies insourced from Orbis through a CEM algorithm. So we have 16,000 company backed by venture capital, 220,000 non-venture capital backed company. And then we use, we match this sample with information from Zephyr on acquisition. And so we got 2,500, bit more than 2,500 companies, for which we have information on the, well, they have been acquired, and we have information on the valuation at acquisition. Then we miss more or less 500 company for missing data, and so the final sample is composed of a bit more of 2,000 companies, out of which 339 company went through an IPO before being acquired. Our dependent variable is Tobin's Q, and our key independent variable are whether the company is backed by a venture capital investor and what's the reputation of the venture capital investor. And we follow previous work in building the reputation of investor based on the share of IPO out of the total number of IPO in the sample, and this is very skewed variable. So we use the threshold of the 75% percentile, and the company is defined as being backed by a highly reputable venture capital investor if one of the investors backing the company is defined as a highly reputable one, meaning that it's in the top 25% of the distribution of their reputation. And then in the robustness check, we play with the number because, of course, the threshold is arbitrary. And in this definition, we use only IPO and not acquisition. But independently of how you define reputation, the results are robust. And then regarding IPO, we distinguish IPO at the NYSE and NASDAQ from IPO in other stock exchanges. We first run a very simple ordinary least square regression, and then we take care of endogeneity issue in the robustness test. I do not have time to go through the result in detail. You find the paper on the internet. I will, and well, of course, we add plenty of controls, and I would like just to focus on some result. Let me start with a very simple result. So first idea is that getting a signal is good for valuation and acquisition. Fine. This it's what we find. And the second point is that getting a stronger signal is better than getting a weaker signal. We find that company backed by in a very simple regression, which forget about signal sequence, being backed by a reputable venture capital investor lead to a 49% increase in Tobin's Q. Being backed by a less reputable one leads to more or less half the effect, 19% increase. Listing at the NYSE or NASDAQ lead to a almost 50% increase in company valuation at acquisition. And quite interestingly, listing in a less prominent stock exchange does not seem to have any effect. And keep in mind that this is, of course, influenced by the fact that going through an IPO is a second signal. And also keep in mind that our presumption is that if you are going through an IPO in a non-prominent stock exchange while being backed by a very prominent venture capital investor, this has a negative impact on company valuation. And this is exactly what we find in our results. If a company is backed by a highly reputable venture capital investor, then going through an IPO in a less prominent stock exchange leads to a almost 40% decrease in company valuation and acquisition, which basically means that the positive effect of being backed by a prominent venture capital investor vanish entirely, right? And how much time? 5 minutes?
Yeah, maximum 5.
Maximum 5. Then let me go rapidly through the hypothesis. So this was a more interesting hypothesis from my perspective. We also find more limited support for the fact that sending a strong signal after a week one increased evaluation of company. And more interestingly, the sequence, when you go through a sequence of a weak signal first, being backed by less reputable investor, and a strong signal later, going through an IPO in the Nasdaq or NYSE, then the combination of this sequence generate a much stronger increase in company valuation than the combination than the opposite sequence of being backed by a reputable venture capital investor, but going to an IPO in a less prominent stock exchange. So the difference is statistically significant and very large. Well, as I mentioned before, there is a very delicate endogeneity issue, because both going through an IPO is a decision of the company, which partly is influenced by the type of venture capital investor you have on board, and getting venture capital investor again is to some extent endogenous, and so we do our best to use an instrumental variable methodology to address this issue in the robustness check section. And we, as I mentioned it before, we wonder whether age matters. So most of this story is about information asymmetries and the role of signals. So we eliminate more mature companies, and the results are still there. We use alternative measure of reputation, which also is a delicate variable in the model. And independently of how you measure reputation, you find exactly the same results. We also consider we also remove the assumption that what matters for company is getting at least one reputable investor in their life, and we consider just what happens before being acquired. And again, the results are there. We also assess the role of time in the estimate, and time is important, but it does not change the core story of the paper. We eliminate low valuation deals, and results are cleaner. And we use quantile regression, and we obtain exactly the same result. So the result, if you manage to eliminate low value acquisition, then the results are even cleaner. Last minute for synthesizing the contribution. Well, first thing, I think most important contribution is to the signaling literature, which is interested in multiple signal, and we mix this literature. We remove the perfect rationality assumption, and so we showed that then under this removing this assumption, the signal are important. Not only the strength of the signal is important, but also the order in which they are conveyed to signal receiver. We also contribute to the growing literature of the dual track process, which generally is considered in a positive way, right? So IPO in general generate more information, which make life easier for company when they are acquired. Well, here we make an hint to this literature, and introducing a possible dark side of the dual track process. And last but not least, we also contribute to the literature, which is interesting in disentangling the substantive signaling value of signals, because if signals do have only substantive value, then the sequence should not be so much important, and this is something that we do not find. So the sequence is important, and this contribute to the idea that signal indeed have a signaling effect in addition to a substantive effect. Limitation is main limitation are the generalizability of the result. It would be interesting to see other settings than acquisition. It would be interesting to see different sequence of signal, for instance, founders, human capital, and VC backing. It would be interesting to go one step ahead and consider sequences composed of more than 2 signals. And also, of course, everything is based on company located in Europe. It would be interesting to extend the geographical scope of the paper. Last practical contribution is to people interested in the dual tracking process. Could be a double-edged sword. Thank you.
Thank you. Great. Excellent. So now I have the job of being a nasty discussant, but to tie some links between the three papers, three excellent papers. You know, as you're bringing up my slides, please. The nice thing I was thinking about is we have, you know, interesting new ideas for data sets using patents and venture capital, misconduct and private equity and venture capital, both in the US and then internationally across all the countries in Europe, where you can get excellent data and work in these topics. So a really broad set of ideas and topics to bring together. If my slides are able to come up from the control center, perfect. Great. So let's a little farther ahead. So I don't want to take up all the time of the discussion. I do want to say a few words, though. And as I was saying before, because we're in Rome, I come to bury Caesar, not to praise them. Similarly, I come to bury our presenters and not to praise them. So let me do that. So the thing I want to focus on first with Gordon's excellent paper is this role of venture capital, being a venture capital symposium here. The thing that really caught my attention is that venture capitalists are entering when there is a loss of IP protection. So to me, that was exactly the opposite of what I was thinking I was going to find. And so the question that came up to my mind was that, well, which VCs are entering? And so the venture capital literature is very much of the opinion that not all VCs are the same. So for example, Massimo's paper, and similarly, Albert talks about some of this, is that venture capital is very, very heterogeneous. One way to do it is just high quality, low quality, but there are many other ways in which you can break those down. And then similarly, I was wondering about how well these investments have fared and syndicated deals and the like. And so, just going back on this issue of, what does the literature say? Well, VCs flock to companies for which there is lots of IP protection. And I went to Google Scholar and found some papers dating back to 2011. I'm sure there's even earlier ones, like Mann and Sager, for example, in a research policy paper. They talk about the importance of intellectual property protection in the self-interest way. I do have some papers on this topic, and so it's exactly what I thought was not going to happen, but it's nice to see results that are a bit unexpected. And so my guess, if we were to guess what's in the data, based on a project that we looked at with some similar kind of context, so we, in this paper that's forthcoming at JVF, instead of looking at reducing IP protection, what we saw is when you have export tariffs getting reduced, so you're at this exogenous increase in product market competition, what does that lead to? Well, it leads to the low quality VCs entering the market, and there are ways in which the VCs behave in terms of changing the nature of their deals when those issues are brought to bear. The second issue I wanted to bring up was looking at these deals in respect to the year, so 2014. So I said 2 slides from now, so let's take a look at that. So 2014, I just picked up some PitchBook data that's available online. You see 2014 being a bit of a banner year. So, maybe there are some other broader industry trends that's being picked up as a result of that increase in supply of venture capital. So I wondered if the experiment of, this legal case is unique or if there's alternative explanations. And so one thing that you might do is benchmark the aggregate 2014 numbers to other years and similarly benchmark industry VC levels from one year to the next. And there are some papers that do some similar things that showing these boom and bust cycles are somewhat predictable. And then going back to, high quality, low quality VCs, there's Gompers and Al paper in the 2008 JFE, do similar types of things that you might want to look at and to know if that effect is a high quality versus low quality effect. The Hatta's JFE paper looks at exits and in IPO, similar to what Massimo had taken care of. So those are some things you might think of. And then finally, as we're, finance folks just love beating to death these alternative explanations and how you might extend that. I wanted to know, how are these VCs going to fare with these deals? How did that affect the total factor productivity of these VC-backed companies pre and post Dallas? If these patents were useful or not really useful or not. So there are lots of new papers that could be written on topic, and Massimo has even a lot of papers that he's looked at before, looking at the role of venture capital and patent protection. So lots that could be done, so excellent work. Then moving over to Albert's paper, as I said, as I read the paper, I was like, wow, this is awesome, totally exactly opposite of what we expect. So we have private equity-backed firms are causing a 140% increase in misconduct. So it's nice to see something that you don't expect. And I particularly like it, if I could give a small plug to a paper that we were very happy to have published in European Financial Management about misconduct risk and how it affects their deals. But again, I don't want to overly praise, but be harsh on the paper. So the idea here, and I saw some things in the slides. I know there are some issues going on here, but I would certainly like to flesh out more to know about which of these private equity firms are exactly generating the misconduct. I would even go so far as to like to see a list of them. And if you did in fact list them, and I don't know if you're allowed to now that you're at the SEC, but if you had even a list of them, that would be super helpful for people that are doing research in private equity and could garner you a ton of citations, because we would be able to use that list in order to make use of that for our own work instead of doing the usual thing of private equity fund fixed effect. For example, we could have like the misconduct ranking of the private equity funds. That would be extremely useful for us. So I hope you would do that. Another thing that would be useful to know, for instance, if we had more details on those private equity fund structures. So, is it something to do with their 2 and 20 payment terms? There's a lot of heterogeneity in their payment terms with, some are 1% and up to 40% in their performance fees, for example. So is it an artifact of their payment terms? Is it something to do with their hurdle rates? Do they, once you get to a certain level and you pay your limited partners, then you get more performance for yourself. And so those hurdle rates might exacerbate misconduct incentives. So the rewards to cheating, of course, are very large, and we'd like to know exactly what's causing this typical or this cheating, and if it has something to do with contractual features. I don't want to talk too long, so I want to open it up to the floor for comments. So another thing could be where there are incentives about changing market conditions with deals. And so, for instance, we saw in a recent paper, when the cost of deals increases, then that causes private equity firms to in fact cause a lot of damage to the companies that they invest in, such as a reduction in their innovative activities. So that might be another angle to take a look at. There are many extensions that you could take a look at here. So there are a bunch of work that is on either side of this debate as to whether these private equity funds are creating more jobs, destroying jobs. It'd be nice to know if which of these private equity funds are engaged in misconduct, and if they have other consequences associated with their behavior, and then even further, if this behavior changed pre and post this 2004 legal decision that Gordon talked about with respect to Alice. So that too could be brought into the analysis here. Even further, in other contexts, I was looking at the SEC Enforcement Division, and I know that within the SEC, they publicly stated that they now have this concern over private equity misconduct, so they created a separate enforcement unit that says, we're going after these private equity funds, we're going to have strong surveillance over these funds and exactly what they're doing, and they have all sorts of types of misconduct. So I'd like to know if it's related, and these are things that are enumerated by the SEC, such as lying about the value of your liquid assets, theft and insider trading, and other conflicts of interest. And so I'd like to know the extent to which these misconducts that you've identified in your paper extend to other types of misconduct that have been identified by precisely your office. So it's fantastic that you're here. So finally, on Massimo's paper, again, another great paper. Most people doing this work on signals look at them in isolation. So Massimo is one with always great ideas, and he's brought this into looking at sequencing of signals, which there are many ways that we could use this in our own work. And so my thoughts are a little bit sort of cheating in the sense of, instead of criticizing, I can just think of a million ideas and ways to extend this. And so my first thought is that, and this is a little bit of a criticism about venture capital work in general, is that in private companies, we only know what's been disclosed to us. Like, it's not like public companies where you have mandated reporting and you know everything about them. So in private company work, we're often segmented by the type of finance that we're looking at. So when we know about venture capital and private equity, we don't know about whether or not they had angel investment, crowdfunding, bank loans, factoring, the accounts receivable, or maybe some government capital. So if you had that, I think that would become extremely useful. And I know you're the master data collector, so I'm willing to bet you actually do have that, and I'm keeping it secret for your next papers, I'm being a little bit joking. The extent to which there are patents in these firms, possibly you can figure that out. That, of course, too, becomes an important signal. Like to know that a little bit more. Also, some things about the financial ratios. You dealt with measures of reputation, but you could bring in other things like their contractual features, for example. If there have been any cases of misconduct, if that's any relevant signal. So if there's misconduct in the U.S., certainly there'll be misconduct in other countries. You do have in consideration of endogeneity. I think you could flush that more to convince us that it satisfies the exclusion restriction. I wondered if any of the deals were grandstanded. If you're dealing with IPOs, that could be particularly relevant. If grandstanding, essentially you have young VCs taking these companies public with the incentive of raising more capital, so they bring them public too soon. And I know you said duration didn't seem to be mattering here, but I think you might flesh that out more for the ones that had duration and incentives to grandstand. That could be particularly relevant. Some of the other mechanisms that you could look at from the time of VC to exit include staging, syndication. Is this a fund manager that's behaving like a mutual fund and investing in tons of companies per manager, or are they doing more value-added active advice by having smaller portfolio size per manager? You could look at their networks, how relevant that is, and their board seats, if those are relevant signals. And then finally, as Albert said, he wasn't sure if he was going to get here. So he had this 2-day trip, and I had this email from him that he's plane delayed, misflight, and that kind of thing. And so I created a gazillion other slides to threaten you if you don't have any questions in the audience, but also in case that Albert didn't arrive. But the other final thing that I wondered in the case of Massimo's paper is that maybe these signals might have different values depending on the identity of the limited partners. And so with a PhD student, we have been examining this, and we've seen that the deals that involving sovereign wealth funds as limited partners seem to be quite a bit worse than other deals. But that's going to be a topic for another day. Or if there are no questions, I'll threaten you with additional slides on how bad sovereign wealth funds are for some of these deals. So again, I really indebted to three great speakers, top scholars. Thank you for coming and presenting these great papers. Nice links between the two and great ideas for us to do more papers on in the future. So why don't we have turn over to the audience? We have 15 or 20 minutes, and hopefully we have some great questions for our panel members. Thank you.
Hi, thank you for very interesting papers. Just have one question for Albert and one for Gordon, if I may. For Albert, my question is, do private equity treat investment in advising companies just like any other portfolio firm? And if this is the case, then have you checked for misconduct in other portfolio firms of the same private equity firm? Or if not, I would like to hear, because that's something I didn't know. And for Gordon, I just want to know the implication of ALICE for any patents which are registered in Europe. In other words, what would be the takeaway or implication of your paper for any patents which are protected in Europe by EU rules? Thanks.
Yeah. So, do they think of this industry as any other industry? And then, so you're saying a private equity firm that increases misconduct in an advisory firm, they're probably doing other things too, right? Other industries. Is this just their strategy? These are the kinds of guys that don't really pay much attention to rules. So no matter what they're doing, whatever industry it is, are they also breaking and bending the rules? First, I don't think this industry is something that's particularly different and unique, so it wouldn't surprise me if other things, you could see that thing in other portfolio companies. But more broadly, and this gets to kind of what, Douglas, you were saying about what happens cross-sectionally, we haven't looked at that, and there's very little that's done where you look at the private equity firm and their entire portfolio of what they're doing. What strikes me is, think of like mutual funds. How many papers are there on mutual funds where you know every single thing about the cross-section and what their fees are and what they invest in? Everybody who does private equity just treats it as one big blob. It's just private equity, 1-0, and that's it. And I think there's a lot of work that would get done to tease out. Of course, you'd have to come up with a misconduct measure for each of the little industries that they're in, but that would be fascinating. It's just like spread out, looking not at a particular industry or company, but within the portfolio of private equity, what they do, whether there's a personality there. I don't think that's really been looked at before. You should do that. That's a great idea. Okay.
Yes, thank you for your comment and your question. With respect to how this impacts international patents, this is really US specific. So these are going to they would still be, to the extent they were able to patent in these kind of computer-aided areas, they still would be able to. But from my understanding of European patent law, it's a little harder in some of these spaces to get the patent protection. The US was maybe too generous initially, but now maybe they've gone the other way and they've become too strict, not giving out at all. So there's got to be somewhere in between. But that's for people who know the European patent code to determine. I need to talk with them. But there's a lot of heterogeneity, even in like the venture capital flows. And if I may, thanks Douglas for your comments as well. Great things to look at. I would suspect these probably are the lower quality venture capitalists, these who are going in with lots of money. But we don't show it yet. And then the other thing of very, very much of interest is, why are they going in? Because they have money, they have to invest it. B, if they do go in, we do show that they are going in relatively into the small company spaces. So they, again, even if they can't patent, maybe they have enough money to outlast the other small companies. So it becomes a money game versus a patent game. But yeah, thank you.
Good morning. I have a question for Gordon. I really like the paper, but I'm wondering, there are several papers that shows that those law firms basically target the big firms, right, for
Yes.
this lawsuit.
Yes.
So you said that the sentence was unexpected, but I'm wondering, since, in the US there is the lobbying and there are a lot of things going on behind the scenes, I'm wondering how much was behind the scene for this happening. Also because now for big firms it's much easier to buy small and innovative small firms. So I'm wondering how much this was unexpected, and because you see a huge decrease in this cost of lawsuits. So this is,
Yeah.
in the US, that's the main difference with Europe, right? A paper like this in Europe, it's complicated because we don't have this habit of lawsuit for
Lawsuits.
everything, right? But in the US, there are papers that shows that.
Yeah.
So I'm wondering if this is really exogenous, or you think that there might be something behind the scene happening?
Well, it clearly were a lot of players. Thank you again for your question. There were a lot of players who were putting money to influence the Supreme Court, and you see that in the amicus briefs. And what happened in this case, there were two sides, both well financed, because you have companies which receive revenue from licensing of patents, like IBM. It's the major source of the revenue. Rambus, a few others. That's, and people say IBM doesn't do anything anymore. They just basically collect fees from their past patents, and Qualcomm as well. Whereas you have the other big companies, like you're right, those are the ones that get sued, who have a lot of money, like the Microsofts, the Facebooks, and they don't like all the lawsuits. It's not just the money that's involved when they're sued for infringement, but it is all the time and attention and so forth. There are a lot of cases out there. So was it really, you could see it in the excess returns at the time the Supreme Court announced it. It wasn't like the recent case where there was a leak. There was no leak in this case, and so no one knew what the Supreme Court was going to do. And the prior court actually held up the patents. So it was, you can see that in the excess returns. So, again, there could have been some calculated bets and so forth, but there was a lot of money going on both sides. So it was a big battle. Again, there was ex post huge impact on the firms involved, on all the firms and subsequent patents. But that is the one, if you don't have any patents, that's why lawsuits went down, because you're not going to sue these rich firms, because in the end, they're for patent infringement, right? So they can infringe because you're not going to win, and that's what happened with Facebook and you look at BlackBerry. BlackBerry don't even make phones anymore. They were just collecting revenues on their patent portfolio from the bigger tech firms, because they had the BlackBerry device, which no one uses anymore. So, but their whole market value was basically suing other firms and the patent revenues coming in. And their market, when they lost that case, and that one they did actually sue for infringement post Alice. So it's a great anecdotal piece of evidence. Their market value fell that day by 40%. Because again, they were suing Facebook and Twitter for encroachment, and their patents were ruled invalid eventually. So.
Hello, thank you for presentations. I have a question for Albert. I'm sorry if I missed this during the talk. You showed us evidence that these investment advisors do bad things after being acquired. The question is, can you show us some evidence that this is profitable from the perspective that do they increase in assets after they increase misconduct, or maybe in terms of the number of clients? And the second question is related to the private equity firms that buy them. So if these are initially good investment advisors, then become bad later, is it true that these private equity firms have some past history of misconduct, and so they, to some extent, select firms that they later turn into bad investment advisors?
So your second question is, do the ones that they turn bad, do they have a history of turning other firms bad?
Yes.
Okay, so it's interesting. I don't think that's too difficult to look at, too. In other words, to what extent is it, can we predict which private equity deals before they happen based on their past history are likely to see this? Because you'd think if it's a strategy, they probably apply the same cookie cutter strategy to every firm they buy, right? So it's like, hey, start cheating this, start putting this product into your clients' portfolios. Why wouldn't they do this for all the firms they buy? So there should be some connection. Like if you do it for one, you probably do it for others. That's something we could actually check, and we haven't done that. Is it profitable? The only thing we had is there was something at the end where we showed that the firms whose assets under management subsequently increased the most correlated with the ones where misconduct also increased the most. Now, that said, that's not necessarily profitability, because if if these things do get caught, you get fined, and each time, this is a pretty big chunk of money. It could be like, I think the average from some papers like $40,000 that you get hit with every time one of these things happens. So it's kind of a trade-off, like, is it worth it to bring in more assets if you get caught and you get fined by the SEC or whatever every time you do this? So we haven't brought in that data on what the costs are of this yet, and that's something that we could mine the text of these misconducts to find out more about.
Thanks.
Thank you very much. I have a very quick question for Professor Colombo. The question is about the link between the bounded rationality, the cognitive cost, and the paper. I was just wondering whether the key element of cognitive cost was on how to justify the fact that we observe an effect when we go to high to low between the first and the second stage, and low to high, and we wouldn't know how to justify this effect from a perfect rational point of view, or whether there was something additional related to the cognitive cost. Thank you.
Okay. No, I think that the approach is very simple. If you are fully rational, then the effect of the signal possibly vanish over time, but is still there, right? And so the question is, well, let's abandon this idea. And when you abandon this idea, it's not clear what are the cognitive approach which replace this idea, right? And in the literature, there are at least two ideas. One is that the most recent information is the one that you consider, right? But the second idea is that you can form expectation in the future based on the trend, right? And even if the trend is a small one, just to signal. And we in the paper we are not really capable of disentangling whether the bias is a recency bias or the bias is a hot end bias. There is some very, very limited evidence in favor of the fact that there may be, let's say, that you find limited support to the idea that there is something more than the recency bias, right? Because the effect is so strong that it encourages us to think in terms of a hot-end bias. But I would not go too much farther than that, right?
Thank you. Gordon, I have a question. Would you expect an increase in the takeover activity after this ruling? Would larger companies be more inclined to buy the smaller ones? And what would your prediction be on the premium? Do you think it would be a higher premium, or because they lose the IP protection, the premium would go down?
We do have some evidence on acquisitions after this decision. Actually, the acquisitions went down. They went down like 16% log, and to the extent we have the value information, I presume the value, we haven't looked at that yet, but the value would probably go down because now the patent is not worth as much. So they would maybe just buying for the intellectual people, the people involved. But they can hire the people, and they don't have to worry about the patents. So there was we don't have the direct evidence on the labor flows, but I would surmise that would be the case. And this is why the small companies put in, again, their protections. They put in a lot of protections which prevent their employees from moving from one company to another company. So that went up. So they had a lot more secrecy, a lot more clauses which allow them to, protect the movement against the movement of their employees. But overall, acquisitions go down. So that, again, there's a lot of acquisitions previously, other people have shown, are for patents. People, the big companies would acquire for the patents as well as the people. Now all of a sudden the patents are not worth as much. And you don't need to acquire for the patent.
I have a question. Okay, go ahead.
Yeah, I have a question. I wonder whether you have data at the individual level, and what happens to this guy who were after they are working for a private equity investor and are involved in this conduct, whether they leave the company or not. Because I think that there are two possible stories here. The one is that private equity are very pushy, and so advisors react at individual level while being engaged in misconduct. But the company do not work, right? Or that is part of the philosophy of the company to increase the margin and to make profit, whatever the cost, right? So I wonder whether you can disentangle these two different stories based on data at the individual level, right?
Yeah, we haven't looked at hiring and firing decisions, but we do have an analysis with a advisor fixed effect to show that it is actually individual people who are working at the firm. So you get bought, you were there at the time, you individually get worse. So now I don't know, once you get worse, do you get fired after that? That we haven't looked at. But there is that getting worse effect as opposed to, bringing in bad people. So, but I don't know if they get kept or if they get kicked out of the firm. That's something we haven't looked at.
Brilliant. I see we're at 12:30. I don't know if I can steal a provocative question or not, but I had the same thoughts on the individual level. I know the private equity business and the venture capital business has faced a lot of lawsuits over gender issues. So I wondered, are men or women pushing these people to do bad? Hey, that's a fun thought for your lunchtime conversation.
I mean, we could do that. We could check the names and see if private equity is making men or women behave equally badly, or if it's only who it is. I don't know. We could do it.
That'd be fun to see. So let me just say thanks once again to Professor Dukas for allowing us to host this session. 3 really terrific papers, great speakers, and really fun time. I hope the session was enjoyable for everybody. Thanks a lot. Thank you. Thank you. Great. Thank you. Thank you. Yes. Really good. Yeah. Thank you. Okay. Good.
Thank you so much.
Thanks. Real good.
Yeah.
Love it. Really.
Next time, I'm not putting the
Thank you.
and I'm just an angle in the next.
Yeah.